And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts. Presented by RIA Advisors.
And good morning and welcome to the show. It is, of course, Wednesday, the hump day edition of the show, halfway through, but it's a holiday shortened week this week. So it's actually more than halfway done. It's actually the second best day of the week. That's right. This is normally Thursday, second best day of the week, but it's actually today because Friday's a holiday for Good Friday. Also means the Easter Bunny's coming this weekend. So my daughter called me yesterday. She's completely convinced that I don't love her anymore, right? Because I told her no, she cannot have an Easter basket this year. She's 18 years old. We're done with Easter baskets. So she said it's the same thing as not loving her. So I don't know what it is. But anyway, but no, Easter's this weekend, right around the corner. And of course, we talked about the other day, if you can't afford a dozen eggs, apparently people are doing potatoes this year. So you can paint potatoes and throw them in the yard. So a couple of things to get into this morning, of course. We'll talk about in the Before the Bell section a bit about the 50-day 200-day crossover. It's the death cross. Dun, 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 right? I mean, this is like where everybody, the headlines start freaking out. You get lots of bearish stuff. We'll talk about the meaning of the death cross a little bit this morning. Also, Danny's joining this morning, how to prepare for a recession. Recession risks are on the rise, no doubt about that. Don't think recession risk is nearly as high as what the media is expecting, but we are starting to see some weakness in the economy. So the economy is slowing down. So regardless of whether it's a recession or an economic slowdown, kind of the same thing. If you're going to see an uptick in job losses, if that occurs, and of course, we'll talk a little bit about, kind of portfolio prepping for a recession as well, or just even slower economic growth, which brings us to earnings as we are in the midst of earnings season. And, so far we're just doing the major banks this week for the most part. Next week, we'll start getting into a lot of the big mega cap companies, et cetera, over the next really week, 2 weeks. Most of your major S&P 500 companies will report by the 25th of April. So we're going to have a really good sense about earnings for the first quarter here over the next couple of weeks. So far, they've been okay. There's certainly not a big concern at this moment in trailing earnings about what's being reported, kind of in line with expected. Estimates have come down pretty decently, so companies are beating estimates. Those are kind of holding up. The concerns, though, are really two things right now, is that there's a lack of forward guidance from companies because they're withholding the guidance because they don't know about tariffs for certain. The other is that the outlook for the economy, for the consumer, et cetera, is becoming a bit more of a concern. So we're seeing that in some of the retailing stocks, et cetera. So again, we're kind of watching those closely, but negative revisions now. We've talked about for a while that earnings have to come down. The estimates were just way, way too optimistic. Those estimates would have to come down. We're now starting to see pretty aggressive negative earnings revision to this point, with earnings for companies starting to be brought down. And that's going to obviously set the markets up for some beats, et cetera. But again, that's not surprising. We've been expecting that for a while. The one area that really hasn't come down a lot yet is small cap stocks. Earnings estimates for this year are still very optimistic for small caps, and that's got to come down a lot. That will likely be closer to zero than the 9% they're currently expecting. And this is particularly the case when you think about the fact that we had really strong economic growth in 2022, 2023, 2024, economy is doing fine. Small cap companies had negative earnings. So if you can't grow earnings in a strong economy, not sure how you can grow earnings in a weak economy, but we'll find out as we get further into the year. But again, just estimates for earnings still very, very elevated despite all the market turmoil and everything that's going on. Rising recession risk, et cetera. That should be bringing those estimates down sharply. That's starting. We're likely to see a more aggressive tune of that as we start to move further into the summer. All right, let's talk a little bit about the markets. Of course, this is what you need to know before the bell this morning. A couple of headlines out this morning. First of all, markets are open a little bit weaker this morning. Tariffs have not gone away. And over last night, NVIDIA came out. They said, hey, we're going to have to take about a $5 billion charge on the G20, which is their stripped down version of their AI chip that they can ship overseas because of the ban on those chips. There's now going to be basically a export tax on those chips. So again, NVIDIA's going to have to take the charge for that. So that's going to weigh on NVIDIA stock this morning. But NVIDIA's been doing well lately. It's actually been outperforming the market for the most part. So again, a little bit of a pullback here. It's really just not surprising, and particularly that we're still getting a lot of this tariff news that's going to keep coming through. The bigger headline that you're going to see a lot today and over the next really kind of few days, and particularly like over the weekend, I'm sure you're going to see a lot of headline and commentary about the death cross, which is this 50-day crossing below the 200-day. Yes, it's concerning for a couple of reasons. One, it provides a more aggressive overhead resistance for stock prices. So as stock prices try to recover back to this level, that 50-day moving average is going to provide pressure, downward pressure on asset prices here near term. And then you got right above that, you got the 200-day. So normally when stocks are trading below the 50 and the 200-day and you do get a cross, as this is happening now, that just means that basically you're in a consolidation or a corrective period in the markets. Now again, when you start hearing terms like death cross, immediately people assume, oh, we're going back to the next financial crisis. No, that's not the case. We can go back in history and you know, again, there's two types of bear markets or corrective markets, I should say, be more fair. You have event-driven corrections, which is what we're in the middle of now, right? So we have tariffs. They were tariffs on. Now they're tariffs off. It might be tariffs on. We don't know, but you have an event, and eventually that event is going to get priced in by the markets. Markets are going to price in tariffs, they're going to reassign valuations, those type of things. So event-driven corrections, like we're in now, tend to last about 3 months altogether. And then markets recover, start to move back higher again. Credit, or what we call more kind of constructive bear markets, which are markets that are driven by a really kind of a credit-related event. Think, dot-com crisis, you had companies blowing up because of accounting issues, Enron, WorldCom, etc. Financial crisis, you had, the whole subprime, kind of credit-related meltdown in the markets. Those tend to last longer. Those are 12 to 18 months. Right? So again, what we're in right now is probably a 3 to 4 to 5 month period where markets are going to struggle, but most likely most of the downside for this current corrective process is likely in. We're likely going to be starting to form bases through here. So again, it doesn't mean you're not going to get another pullback here, potentially a retest of lows. Don't be surprised with that at all, and particularly with this kind of declining, resistance that we've got at the moment. We've got the 50-day pointing lower, you've got the 20-day pointing lower. That's going to continue to put downward pressure on prices. Every time markets rally back towards these resistance levels, as we are right now, right? We rallied off last week, came back up this 20-day moving average. We're struggling with that right now. Market's going to be down a little bit this morning. We're looking at Dow being down about 41 points here at the open. So markets have been struggling here for the last few days, in particular right around this 20-day moving average. You're going to have the same problem when you get up to the 50-day moving average. So that's going to continue to kind of keep us in this kind of sideways grind process probably for the next 2-3 months. And so it's going to be a little bit of a disappointing market. The kind of this, every day you come in, the market's up 1% a day or whatever. That's probably behind us for a while. Early this year, we said that markets were going to, we talk about curb your enthusiasm. Markets are going to be more volatile this year, probably not make a lot of money this year. That's certainly been the case so far, and it's likely going to be that way here for a while because we are in an event-driven correction. We're not through that event yet. And markets still have to digest what all this means for stock prices and forward earnings. Those are starting to come in line, but more work to do there. But we'll come back. We'll talk more about this. We'll talk a little bit about the history of it. Also talk about recession prepping your portfolio as well with Danny Ratliff. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN. Or online at realinvestmentadvice.com.
In 1999, a parafiduciary group of financial advisors were busted by corporate giants for trying to operate in their clients' best interest. These men promptly escaped from a high-cost margin environment to the Houston Energy Corridor. Today, still excoriated by their former employers, they survive as protectors of others' fortunes. If you have a problem about preserving capital, if no one else can help, and you can find them right here, maybe you should hire the RIA team.
The Real Investment Show.
RIA Advisors Research is the envy of the industry. Our economic insights are featured on advisorperspectives.com, Fox Business, and MarketWatch. RIA provides advisors with marketing and back office support, objective research, and holistic, cutting-edge financial planning tools to meet your clients' needs. Want to join a winning team and be part of a fiduciary culture where you can do your best work? Then why haven't you contacted us yet? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors. Big enough where it matters, agile enough when it counts.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors. 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
All right, welcome back to the show this morning. Morning, Danny. How are you?
Hey, morning. Doing great.
Good. What you been up to lately? Because you weren't here last week. You out signing books again?
I was. On the book trail.
How's the book tour going?
Fantastic.
It's awesome.
My dad's birthday's coming up. I'm going to give him one.
Nice. They'll like that.
Yeah, we'll see. Yeah, I think he'll like it. He's a pretty good sport.
There you go. All right. So a few things to get into this morning. I touched on just a second here and before the bell. Brent needed an out for that. And that's what you need to know before the bell. So, there you go. I didn't give him an out on that one. So, what, you didn't like that one?
Different background.
Nobody will ever notice. Anyway, we're just talking a little about the 50, 200-day death cross. And again, you're going to hear a lot about this, particularly, from the more bearish leaning side of the financial media. And I just want you to be really, really careful with this because it is important. And it is something that is certainly worth paying attention to. Absolutely. You shouldn't ignore the negative crossover of the 50 and the 200-day moving average, but it's also important to keep things within context. And as we've talked about a lot before, it's always about perspective and, having an understanding of how these things relate through history. And like we talked about yesterday, we talked about the dollar, right? And it's like, it's de-dollarization. Nobody wants the US dollar anymore. And that's why the bond market's blown up. No, it has nothing to do with the dollar. It has everything to do with the basis trade. That's why you've had a lot of havoc in the bond market over the last week. In fact, they just announced the first casualty of that. It was a hedge fund, about $10 billion that blew up. And so they're kind of working through that process right now. And they're probably not the only one. That's just the first one we know about that got put on the ropes by, yields going in the wrong direction with too much leverage. So had nothing to do with the dollar. But, that's the bearish headlines you get. As we showed you yesterday, if you squint really hard, you can see the decline in the dollar when you put it in context of a longer term market trend, right? And where the dollar's trading about where it was in 1975. And it's just been sideways. It goes up and down a lot because, we're, constantly rebalancing our currency relative to other currencies. And so it goes up and down a lot, but basically you can draw a straight line through it and it just trades in a big range. And that makes sense because we're just, we want to keep a relative peg to other currencies so that we can trade effectively and we can buy stuff really cheap. Speaking of buying stuff, we have retail sales out this morning, so that'll be interesting to watch. Very weak last month. I expect there's going to be a pretty decent, strong rebound in retail sales this month. So again, we'll talk about that tomorrow with Michael Leibowitz. But I want to bring up this chart. So this chart is a little bit hard to read, but I'll kind of walk you through this. But this is a 30-year chart of the S&P 500 on a log scale. So you can see the dot-com crisis, you can see the financial crisis, you can see 2022. If you squint really hard, you can see the meltdown and COVID. But the red and the blue lines, that's the 50 and the 200-day moving average. So the death cross, right? This is what you're going to hear a lot in the media. It's like, oh, the death cross has been triggered in the markets. And it certainly sounds, very ominous. It sounds very dangerous, and it sounds like something you really should pay attention to. But again, it depends on the context of when that moving average is triggered and what's going on. So we just really talked about, kind of an event-driven bear market and a more of a structural bear market, right? So structural bear markets were 2000, 2008. Those were structural bear markets. You had Enron WorldCom blow up in 2000. You had the subprime crisis in 2008. Those are structural bear markets. There were things happening in the economy, and they were also tied to fairly deep recessionary movements at that point in time. Outside of that, you'll notice that we had a 50-day, 200-day crossover in 2011. We had one then again in 2013, and we had one in 2015, 16 with Brexit. You had one in 2018 when we had the Fed taper. You had one during the COVID pandemic. And then you had a 50, 200-day crossover in 2022. So most of the times when they're event-driven bear markets, so 2022 wasn't event-driven. We had recession concerns and we had Fed's hiking rates. So that was more of a structural correction. It wasn't a bear market, but you had a correction during that process. But outside of that, there's a lot of these periods that are fairly short-lived. They last 3 or 4 months, and then all of a sudden the 50 days back above the 200 days, it's like it's the golden cross, right? You should be long stocks. Well, if you sold the market with that 50, 200-day moving average crossover, you kind of sold the bottom in 2010, 2011, 2015, 16, because those were just short-term events in the markets. And so again, the thing we need to separate out here is before you start making big market moves based on a headline of a 50, 200-day moving average crossover, just understand that we are an event-driven crossover right now. It will probably be short-lived unless this evolves into a much larger recessionary drawdown of the economy, which we don't have any evidence of yet. There's a lot of speculation and hype over that, just like we had in 2022. Remember, everybody was 100% convinced we were going to have a recession in 2023, right? Didn't happen. We now have 60% probabilities of a recession this year. There's a probability that may not happen because when everybody expects something to happen, it generally doesn't happen because markets adapt for that. So markets are working through that process right now. So again, just the whole point of the conversation, and I'm going to throw this over at Danny here just so he can give you some his views. But just be careful with narratives, as is always the case, because you have to put these in context with perspective about what's happening in the overall markets. Danny?
Yeah, but not to mention, you've mentioned often that, moving averages, we have them there for a reason, right? Mm-hmm. We typically many people look at the 20, the 50, the 100-day, the 200-day, and especially what we're talking about right now is the 50 and the 200-day. But a lot of the destruction in the market's already been done as we've already seen the 50-day cross. Right. And so if we go back and look, about 80% of the time a year later, the market is actually higher. And so that's why it's very difficult to go make knee-jerk reactions. Now, does that not mean we need to have a very good understanding from a cash flow perspective? Are you taking distributions, income? What do you need from your accounts? From a risk management, can you sleep at night? And I think that's what's difficult right now, Lance, with so much different information coming out there. And, especially when we see something like this, it's flashing all over the headlines. Media is, running from place to place screaming that, hey, this is it. And how many times have we been there? And so you said 2022 wasn't a bear market.
Right.
But you can't tell that to the average investor who's, S&P's down 18, NASDAQ's down over 30.
Right.
Bonds, long-term bonds were down over 30. Intermediate was down almost, 18 right there, with what the indexes were doing. And so, when we think about this, we have to be cautious. And so know yourself, know your risk tolerance, what you're trying to accomplish. And, talking about, Treasury Secretary and some of the things that have occurred, Scott Bessent actually had an interview yesterday with, Yahoo Finance. And, when we're thinking about an event-driven economy as far as or market at the moment, there's a lot of things that aren't being talked about. And granted, because the big news today is tariffs, but he's described something which he said multiple times already. Look, we have a three-stool approach, three-leg approach essentially, right? And so your tariffs, tax cuts, which he did give a little bit better barometer as far as when he anticipated having some of this stuff done. But looking at July potentially, which is something we've thought it'd be end of summer, somewhere in that ballpark. And, as you're doing that, and then deregulation. And so those are other aspects that can change the narrative quickly, especially if you get some type of agreements on tariffs. Right. And so they alluded to 15 big countries are working on tariffs with, 14 if you exclude China. Headline just popped up, oil prices are up. China signaled they're willing to talk. We do have the IMF meeting here this next week, so it would not be unlikely that they run across each other, have some discussions. So a lot of things that are moving at once. One other thing he mentioned is that nobody's talking about, like the FCI, so Financial Conditions Index. All that's still in line.
Yeah,
there's nothing to suggest that we're falling off the cliff, and I think that's one thing that's difficult when we hear all the narratives and all the different storylines around this, and yet economic data is not terrible. Sentiment's not great, and rightly so. And so we're going to talk about some things that you can do to determine, hey, how do you, kind of fortify your household in an environment where maybe we are getting into a recession. But right now, everything's okay. But markets don't like the news. We don't like the potential outcomes from what the worst case scenario, and that's what the market's looking at right now. What is the worst case scenario with tariffs? They're not looking at what's the best case scenario, at least not yet. But once you get some, you get some other countries coming to the table, that changes and likely will change very, very quickly. I've been telling people, and you may or may not agree with this, Lance, is, if the United States and China made a deal today, the market would likely make last Wednesday look like child's play, right? I mean, it would be up more than 10, 12%.
Sure. Yeah, and that's kind of one of the interesting headlines I wanted to get to you today. There's an article out on, who was this? Was this Wall Street Journal? Yes. No, it's Market Watch. Wall Street predicts a 10% stock rebound by the end of 25. That happened in a day when Trump came out and put a pause on tariffs. By the way, we now know the limits of where Trump will go to in terms of market pain, because remember, he was all for, hey, market pain's fine. I'm not worried about the stock market at all, until he couldn't take it anymore. And then the Trump put came in.
Well, do you think it was because he couldn't take it anymore, or do you think it was because of those underlying factors like you mentioned?
No, he was getting calls from from CEOs of banks and hedge funds going, you better fix this before you really mess something up.
Because something was about to
break.
break.
Exactly. So we know where that is now.
Yeah.
But yeah, to your point though, expect a 10% rate rebound by the end of the year. Probably. It wouldn't be surprising.
Maybe tomorrow.
But you get a deal, it's tomorrow.
Yeah.
Right? We'll talk about that when we come back from the break. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Oh, Red, I declare, I plumb missed that candy coffee. Whatever am I gonna do?
Don't you worry, little darling. We'll watch it again on our YouTube channel.
Why, Red, I never.
The Real Investment Show YouTube channel has all of our past presentations, from Candid Coffee and Lunch and Learn to special topic discussions, and all of our live show recordings preserved for you. Subscribe now to the Real Investment Show YouTube channel, or look for the link on our website at realinvestmentadvice.com.
Are you a financial advisor sneaking peeks at our stuff? Instead of trying to do it all yourself, why not just join the team at RIA Advisors? Our full-service organization can provide you with the support, unparalleled research, and tools for managing your clients' money and honoring the fiduciary pledge of putting clients' best interest first. Don't take our word for it. Talk to the advisors that work with us. Want to come win with us? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors, big enough where it matters, agile enough when it counts.
The Real Investment Show.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN. Or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
By the way, have you seen 1923 yet?
Yes.
I have a major beef with 1923
Uh-oh,
on
okay.
multiple levels.
The Real Investment Show podcast.
The stuff that was happening in that show would not happen to normal people, ever.
We were watching that too, Shauna and my wife. This is so exaggerated. There's no way that this would happen in real life. This Taylor Sheridan, boy, he exaggerates it. I'm just like, just watch it for what it's worth.
Very entertaining. Just at the end of it, I was very frustrated at the end of it. I was like, after all they went through, can they just be together?
Yeah.
At realinvestmentadvice.com.
I digress. Credit spreads, though. But this is the issue with credit spreads, right? It's the 1923 version of credit spreads, which is we got to make it so dramatic.
The Real Investment Show.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
If you're working and looking to retire soon, a Medicare special enrollment period is in your future. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in penalties. Make sense of Medicare's alphabet soup with RIA Advisors online resources and one-on-one partners to help secure the healthcare insurance choice that is right for your lifestyle and budget and avoid gaps in coverage. Click on the insurance tab at realinvestmentadvice.com today. realinvestmentadvice.com.
You're listening to The Real Investment Show.
Just real quick, I wanted to, touch on something that Danny said because it's an important point about markets. And I'd made the comment that 2022 was not a bear market, and Danny correctly said that for the average person, they certainly felt like it was a bear market because you hear the media come out, right? The media is like, oh, the market's down 20%, we're in a bear market. No, that's not a bear market. 20% used to cause bear markets back, pre-turn of the century, when we still had to put paper in tubes and send trades up vacuum tubes to get them executed. But really, since the turn of the century, that's no longer the case because markets have gotten so deviated from long-term moving averages that corrections back to that moving average is going to require a much larger drawdown in the market just on a percentage basis. And so I just modified that chart I showed you earlier. And this is a weekly chart. And this shows you a 52-week moving average and a 400-week moving average. And what you'll notice is that the 400-week moving average tends to act as support for the markets against the long-term moving average. So it tends to act during rising bull markets. It tends to act as support. When you get into a real bear market is when you actually start to trail below that long-term moving average. In other words, the difference between a correction and a bear market is when prices are trending negatively over a long period of time. So 2000,
dot-com crash, 2008, you were well below those averages for a long time. You trailed below the 1 year moving average. It was kind of the overhead resistance. Every time the market got to that 1 year moving average, it trailed lower. But you went through, and again, as I said earlier, difference between an event-driven bear market and a structural bear market. So those were structural bear markets. Those were actual bear markets. You'll notice that since then, really since 2009, we've just been in a rising bullish trend. So prices have never really broken that long-term bullish trend ever since 2009. And so a correction now to get back to that long-term moving average would be nearly 40%, peak to trough. So again, that's why, it's people are going to hear, oh, it's a bear market. And it's like, no, we're going to be down 20, 30% before you even start talking about just getting back to long-term trend support for the markets. And then if you break that long-term moving average and then stay below it, now you're in a what's deemed a real bear market, and we haven't seen that one yet. So just a bit of clarification, because again, as we're talking about this morning, you're going to hear a lot of this stuff coming up. It's like, oh, we're in a bear market. The death cross has occurred. We're in a bear market. No, we're not in a bear market. We're in a corrective market, and it's going to be that way until we're not in a corrective market anymore, as we talked about earlier. But it does bring up a lot of questions about actions you should take, A, during this type of market environment, and B, if we do have a recession later this year or next year, what does that mean, right? And so again, as we've been kind of talking about this morning, you've got to be careful about making big major moves, because in a event-driven cycle like we're in now, they tend to be short-term in nature, 3 months on average, and then they're over, and then markets are going back to doing what they're doing because they've priced in whatever that event is. And so the event right now is tariffs. So we'll get through this, and markets are already figuring out what tariffs mean, and that's what all this turmoil in the market has been lately, is markets trying to reprice for what tariffs mean going forward. It's not... The markets still have to figure that out. They're doing it now, and they're going to figure out what tariffs mean, and then we're going to find a new level of valuations where markets say, I'm good, right? I'm good with these. Tariffs are fine. I'm good with valuations where they are, and they're going to start moving markets in that direction. And then we're going to start looking forward about what comes next after tariffs. Do we get economic growth? Does the economy start to doing better? Do we reduce our debt and relieve some of the issues on our budget? Those type of things. We're going to start looking past tariffs onto whatever's next on the horizon, and markets will start trading off of that. What is AI and what the future looks like, and all those type of things will all start to feed in to these estimates, outlooks, and earnings for the markets. But it does. But again, in the short term, lots of volatility, certainly a lot of stress. Danny's been just on phone calls nonstop for the last couple of weeks. But, is there anything that, and I kind of talked a little bit about RMDs yesterday. We had a question about Rule 72T.
Yep.
Yesterday, but also talking about RMDs is now the time that you take RMDs, or you still wait for the end of the year, especially if you're expecting the market to rebound by year end?
Yeah, where's that magic 8-ball? If we do see markets actually go up, well, then obviously we'd want to wait and see if we're confident in that. Now, the problem is that nobody knows this, especially right now with all that's going on, right? This is much deeper than just tariffs. Tariffs on the surface is the headline news, but as you and I have talked about, you've talked about with Mike, that this is actually, going on trademark infringement, going on so many other things that I think that we're losing sight of, that it's a little bit bigger than just the tariffs. And so could this be extended? Could the market, do we see this escalated? Is this something like the Cold War with Russia and the United States going back and forth, right?
Right. Yeah. That's good. That's a good kind of analogy.
Yeah. So does this go on for years, or does this go on for months? And that's the big question that nobody knows. And, Trump has held everything he keeps his cards under the table, everything very close to the vest. And I think that when, that's the art of the deal. I know nobody likes that aspect of it, but when he's trying to make these deals, that's what's causing a lot of the uncertainty with markets. And so we have to be a little bit cautious here. So if you were more inclined and said, hey, I don't know where things are going to go, maybe you take a little bit of your RMD now, you take a little bit of it at the end of the year in hopes that the markets do recover, or you find an area that you're comfortable with. I mean, there are areas of the market have done well, and so that could be an avenue to go ahead and take it. But in general, I mean, I like to think I'm more optimistic than pessimistic at the moment, and I would say I say that with great caution, but markets have been hit pretty hard. We've seen a nice little retracement here. Do we get some more upside? Then yeah, maybe you take it a little bit later. But if you are super concerned and you feel like, hey, markets are just going to go down, now you got to remember that's emotional, but maybe you go ahead and start taking those RMDs now. We talked about Roth conversions. We spoke about that a bit last week, where we've been more inclined, especially wanting to know exactly what the new tax bill looks like. What will they actually be able to get done? And so we'll be able to plan with much more clarity moving forward into the future with that. But do you go ahead and start looking at taking an asset that has been hit rather hard, that you have conviction in, moving that from the traditional to the Roth and let that appreciation occur there? That's a strategy that we're starting to look more and more at, where even a couple weeks ago, I was more inclined to tell somebody, hey, let's get more a clearer vision on taxes and what that looks like, and then we can make that decision. Now I think we're a little bit more inclined to do so now with a Roth conversion. RMDs, that's going to be more personal, but if you feel like the market will go up, you wait. If you feel like the market's just, it's in a downward spiral, you go ahead and take it out.
There you go. I agree.
And that's the challenge. And so when you think about, how do we distribute? When do you distribute? That's always a challenge. And some people may say, we're going to kind of dollar cost average out of something too. So you don't have to do it all or nothing, but you could also do it a little bit each month. And so you let the market and the economy kind of ebb and flow. That's another strategy that you could utilize. I know a lot of people utilize that to get into the market. You can also do so to get out. So where a lot of you out there are probably getting monthly distributions, and many times it's in the amount of your RMD. Think about that. Another thing that we should be considering, if you're charitably inclined, you do have assets that have been up quite a bit. Look at that qualified charitable distribution, or from for an RMD. So that's if your RMD age, you have you can do up to just over $100,000 this year. But I know most of you aren't doing that. But also, if you had a stock that has been up significantly in a taxable account, look to donate that stock. So that way you're not going to pay capital gains on that appreciation. And so many times, a lot of charities will allow you to actually move that individual stock over. If not, you could create a donor advised fund. And that's another avenue that you can do so. Like we work with Fidelity. They do that quite a bit. Pretty easy process. Once you get the account set up, they take care of all the accounting, everything else you need to do, and distributions to that particular charity that you want the funds to go to.
That's right. So, and again, this is, this is part and parcel of, kind of these market environments that we're in, where you have these corrective markets that are happening right now because markets were overvalued coming into this year. And we talked a lot about that last year. And we'd written a lot of articles that, some event would happen. And this was kind of the crux of the article on Curb Your Enthusiasm back, right, I think it was on January the 7th, I wrote that article, saying, hey, expect a lot of volatility this year. There'll be some event that occurs, and it's going to cause market volatility. And so we've had an event with tariffs. And, so again, you can't equate market volatility with, other stuff that's going on in the markets or in the economy or political policy or whatever it is. Those are all kind of segregated out. What markets respond to are events and things that change the outlook for earnings. So again, all that's happening right now is that markets are changing their outlook for earnings. They were too optimistic. We've written that several times coming into this year. And you were going to have some event that causes that reassessment of those earnings expectations lower. And that's what's occurring. And so that's going to change valuation outlooks. That's going to change a lot of things. But again, very importantly, this is going to pass. And markets will reassess valuations, and then markets will start to rally again based on what the future looks like. And they're going to go back to what AI looks like, or what, the economic growth story looks like, or what, other events are going on, what those mean, and there'll be a more optimistic look. So this is why you want to be really careful about being overly bearish. And this is the problem that Danny and I run into a lot, is that people that have a more tendency to be more bearish in their outlook, they stay out of markets for very long periods of time. And because they're so concerned about loss and loss avoidance. And I don't want to get swept up into the big crash. And so the problem with that is that view is fine. And so finally the market corrects, but they still don't get back in because now they expect the market to correct even further. So we'll come back and talk about that, because the markets right now, and what historical statistics suggest, is that markets will rally by year end. And the question is where do you start buying in this market? We'll talk about that when we come back from the break. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
The Real Investment Show YouTube page has all of our videos ready for your easy access. From 3 minutes on markets and money to each day's radio shows like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel for The Real Investment Show, or just click on the show links at realinvestmentadvice.com.
RIA Advisors Research is the envy of the industry. Our economic insights are featured on advisorperspectives.com, Fox Business, and MarketWatch. RIA provides advisors with marketing and back office support, objective research, and holistic, cutting-edge financial planning tools to meet your clients' needs. Want to join a winning team and be part of a fiduciary culture where you can do your best work? Then why haven't you contacted us yet? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors. Big enough where it matters, agile enough when it counts.
The Real Investment Show.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN. Or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So it's interesting to read. I read the chat on the breaks, and it's always interesting some of the stuff that y'all talk about. First of all, you don't know my diet at all if you think I eat chicken fried steak. Okay?
I don't even know if that's a cheat day for you.
It's not a cheat day.
I mean, you are so boring.
I am absolutely. There's two reasons I'm boring: because I'm old, and digestion doesn't work quite the way it did when I was in my 20s. So there's certain things that I just don't eat anymore because it's not worth the agony later.
Well, it's like Richard says that every time he has a donut, he puts $1 into his health savings account.
Well, he must have like $1 million in there.
I don't know. I think he's pretty good about that.
But speaking of, you mentioned earlier, you asked where the 8-ball was. Where is the magic 8-ball?
It's right here.
Oh, it is right there? Okay, because apparently somebody in chat says that Rosso said not to ever mention the magic 8-ball ever again. Did it not answer something correctly for Richard? Do you think it crossed him? Yeah. Gotcha.
Well, that's fairly typical.
I mean, generally Rich is wrong, so always trust the 8-ball. It's my opinion.
Is Richard wrong? Outlook not so good. Oh, so that means he's right. Okay, that's great. See, Rich?
And then actually the serious question is that there was a request that says, why don't y'all do tax prep? And look, we focus on a specific niche of clientele, and that niche is between generally $1 and $5 million worth of net worth. That's kind of our primary focus because they're a very underserved segment of the market. Big institutions like JP Morgan, Goldman Sachs, et cetera, they're constantly chasing guys with 10, 20, 30, 40, 50 million, $100 million.
But they don't do that. And we do have a large segment of clients in that space.
We do. But we have a very specific niche that we focused on for a long time, and we do well with it. But most of those people already have their own tax planners and everything else. So employing that staff is really the cost-benefit analysis of it for us. And so, we can certainly work with your advisor, your tax advisor. So if you have a tax planner, if you have a tax accountant, more than happy to work with them. Danny works very closely with estate planners, tax planners. It's all integrated. But, a lot of people have preferences too. But they have a particular, I have a tax accountant that I've used for 30 years, and I've been working through the generations of the family. Yeah. But I'll stay with them because it's just a personal preference. A lot of people have personal preferences.
They know you and you know them, and it's nice when somebody knows your situation. And
they know where all your skeletons are buried.
I do spend a lot of time with family offices, with attorneys, estate planners, with CPAs, and we've had that discussion actually many times about bringing somebody in-house internally. But when you see a lot of small shops, especially CPAs who become financial advisors, and my struggle with that is that if you're doing taxes for a big part of the year, how can you effectively manage funds without, now this is somebody who's maybe a one or several person shop, without just setting a buy and hold strategy or selling a product. But if you want true advice, and we're big enough that we could hire somebody to do that, but we don't want to take away from all that. And I do enjoy visiting with different CPAs. We do a lot of tax planning work, but we always encourage our clients to run it by a CPA because they know your situation better than you do. We do a lot of things around taxes, right? How do you liquidate specific assets? How do you, we talked about charity. If you're charitably inclined, what's the best way for you to do so? And so we're always looking at how to minimize taxes, keep more money in your pocket, but we are not filling out your 1040 and doing that. And so, there's a lot of that tax planning that goes on, but we are not CPAs. We don't do taxes, and we encourage everybody to run that by their CPA and work together hand in hand to make sure that we're not missing something.
That's right.
But yeah.
But no, I mean, it's a good question, and there's a lot of companies, and I think your answer was the best. Is that there's a lot of companies that try to offer kind of the full suite of stuff. They do everything, but you sacrifice in that environment, and generally it's a buy and hold investment strategy. And they do tax planning and they do other stuff, right? But if you want active management and a lot of in-depth research and analysis and those things that actually manage your money as well as doing your financial, we do super in-depth financial planning, analysis, all that type of stuff. That's where we focus our efforts. So we do what we're best at, and then we let other professionals who are best at those jobs do those jobs.
Well, and we also have a lot of different niches within the firm as well. So like I deal with a lot of our C-suite executives, small business owners going through liquidity events. So typically, a little bit higher net worth sometimes. And so we're dealing and seeing with a lot of different, different strategies. If you have non-qualified stock options, if you have other types of moving parts that we need to be concerned with within your plan. And our planning team is phenomenal when it comes to that. And so we are looking at every aspect of it. You hear Lance every day, and so you think, oh, it's all about the investment management. Well, that is a very large part, but the investment management is tied to that financial plan. And so our goal on the other side of the ledger is to get a very good understanding of the families that we work with, what their goals, their intents are over time, and then how do we get them there to reach all those objectives and minimize taxes, keep more money in your pocket and out of Uncle Sam's, make sure that the estate plan is done properly so that everything is executed. If you pass, what's the burden on your heirs? What does that mean? And so we want to make sure that everything is buttoned up, and I think that gives a big advantage long term, knowing all of that. And I would much rather do that than do taxes. I mean, taxes, good Lord, I don't think I could. I'd be banging my head against the wall. I love finding ways to save people money, but I just don't think I could fill out the docs day in and day out.
Exactly. No, it's true. And then that's the problem really too, is that, it's just, it's a function of speciality. And again, you don't go to a doctor to have him take care of, your, financial issues, right? It's just, you go to a doctor because you have specific needs. So you want the best in their fields for whatever it is. And that's why we really focus on what we do, and we try to be the best at what we do.
Well, and one more thing before we move on that, so think about this. If you go to a dinner party, you meet a CPA, and they're talking about, who do you use? What do you do? Oh, I could save you money. Great. Now, here's the problem, and they are unfairly judged. We judge a CPA on how much money they can save us today. Our job is to look at not only how much money you can save today, but what about the future? What can we do right now to minimize those taxes going forward? And unfortunately, that's how they're judged. So if your guy says, oh, I saved you X amount of dollars, and this guy promises he's going to save you more, you're going to be like, yeah, I'm going to make a switch. So they're not incentivized in general to look further. So it's not as much tax advice, for future. It's more about what they can do for you today. Yep. And so that's one thing where, we have to have a lot of discussions, and sometimes we don't see eye to eye, but many times they come around and say, you know what, that's not a bad idea. Here's, we explain why, the thesis behind it, and it works very, very well.
Yeah. Another question we had here, this is actually a really good one, is does anybody have a general strategy to buy 10% down, 20% down, wherever? That's when we focus a lot on basic technical analysis. We're not technicians by any stretch of the imagination. And we talk a lot about technical analysis in our articles and in our show here, because that's what helps us understand when to buy or when to sell stocks. And that's why when markets are rallying, we talk about taking profits, rebalancing risk. When markets are down deeply, that's when we start looking for opportunities to add money to equities, like we did just last week. So again, those there's this a lot of the problems that you'll see is that people say, oh well, if it's an 8% decline, you have to sell everything. Percentages are really bad to use for anything because markets are different all the time. Again, a 20% correction doesn't get you anywhere near a bear market in terms of breaking a bullish trend in the markets. 20% correction won't do that. It's going to be 30 to 40% to break that trend. So, using percentages are never a good idea. But understanding, when are markets deeply oversold? When is sentiment deeply, deeply negative? Those tend to be good contrarian indicators. And again, it's not a buy everything type analysis either. But you could be down 10, 15, 20% and, be a great buying opportunity. And we saw, over the last couple of years, 8, 9, 10% corrections were great buying opportunities to put money to work. Peak to trough this year, we're down about 15%. And you've had a decent buying opportunity from those lows when we were down about 15% from the peak. That was a decent little buying opportunity for a trade. But it doesn't necessarily mean it's a long-term buy. And, we're going to see here, but this market will eventually begin to form a bottom. We'll be able to see it in pictures. And then you'll know to start putting and allocating more equity risk to portfolios. But this is one thing I left off with Danny just before going into the break, is that one of the things that we see a lot, and particularly this thing you got to be careful with markets like this, is being overly negative. Because what happens is people are overly bearish about topics that have really nothing to do with the markets. They hear stuff on the media, they watch YouTube videos, whatever. It's like, oh, this guy says the market's going to crash because of the debt or whatever it is. And those two are not connected at all. So they stay out of the market. And then the market eventually does correct. And now they're convinced the market's going to, the crash is finally here. And now we're going to go to zero. And they still don't buy. And then the market begins to recover. And it's like, oh, well, it's just, this is just a bear market rally. So then they don't buy. And then the market keeps rallying, get back to new highs. Well, now it's overbought and now they don't buy. And Danny will tell you, we've told you this on the show before, we still get people today that have been out of the market since the financial crisis.
Yeah, no doubt.
And and just can't figure out how to get back in. So again, this is why a lot of these narratives are best. And we talk about this a lot, is just turn off all the media. If you want to manage your money better, turn off the media and just focus on what your portfolio is doing. Focus on understanding some basic, if you're going to manage your own money, you've got to understand some basic technical analysis, moving averages, a MACD indicator, relative strength index. It's about all you need, right? If you just can understand those and apply those to what you're doing, you'll manage your money better. If you can't, go hire somebody to do it for you. Again, not necessarily a doctor to manage your money, but, hire somebody that can, has your same views, has your same outlooks, has your same, best interest at heart, but get somebody to take the work off of you because they'll do it better over time. And it'll be worth the fee that you pay, as is always the case. All right, wraps up the show for today. Danny, thanks so much. We'll be back tomorrow with Michael Leibowitz. We'll get up on retail sales, earnings, and kind of the outlook for the bond market. Is the basis trade finally done? Is that whole blow up over, or are we still in process? We'll talk about that tomorrow with Michael Leibowitz. Don't go away. I'll see you back then.